Hi guys, keep watching KS tutorials. They are the best.
Guys, keep watching KS tutorials. They are the best.
Hello guys, welcome back to another interesting episode of KS tutorials. KS tutorials, you keep calm and then you balance on. We want to apologize for going on a very long break. It was a break that we needed to embark on, but we are back online. We are back on bringing you all the interesting episodes in accounting. We are back on making accounting very simple for you. So keep calm and then stick with us. Continue sharing our links to your friends, your colleagues. Tell a friend to tell another that KS Tutorials is back. KS Tutorials, keep calm. KS Tutorials, balance on. So we've been having discussions on so many different topics of accounting, but today we'll be talking about analyzing we are going to talk about how to analyze business transactions. How to analyze business transactions. So when we talk about analyzing business transactions, let's say you bought asset 5,000 Ghana cedi. It's a business transaction. How are we going to analyze it? So analyzing talks about examining the transaction itself, what took place. You are going to examine it. You are going to identify the assets in it. You are going to identify the liabilities. You are going to identify the key components of the transaction. Do we get it? That is analyzing business transaction. So we are going to talk about examining financial activities. I'm going to talk about examining financial activities. That is what we term as analyzing business transactions. So before we analyze business transaction, any business transaction, before we analyze, there are some points that we need to note. Before we analyze business transaction, there are some points we need to note. So to make the analysis very simple for you, you need to know that each transaction stands alone. So before you analyze business transaction, you need to know that every transaction stands alone. So let's say we have Amma started a business with 10,000 Ghana cedis pitch, and then in 1 month time she purchased an asset worth 5,000 Ghana cedis. We've talked about two transactions. So Amma started a business as one transaction. That transaction stands alone. She purchasing asset 5,000 also stands alone. So we don't need to combine the two. Every transaction stands alone. We don't need to mix them up. Amma started a business as one transaction. Amma purchased assets, another transaction. They stand alone. Do we get it? So every transaction stands alone. Okay. So the next one we need to know is there are two parties to every transaction. So we need to know that every transaction has two parties. Every transaction has two parties. So Amma started business worth with 5,000 Ghana cedis or 10,000 Ghana cedis. What are the two parties here? Amma, who is starting the business, and then the cash she's starting the business with. That's the two parties here. Do we get it? So every transaction has two parties. Amma purchased assets worth 5,000 Ghana cedis. So she purchased the asset worth 5,000 Ghana cedis. That's one transaction. And then the asset is also another transaction. The asset she bought is also another transaction. So if we understand these two transactions, or the parties to the transaction, we know that every transaction has two parties. Let that one stick to our mind. We should keep that in mind, that every transaction has two parties. Every transaction has two parties. Okay. Then the next one that we need to know is read every transaction from business standpoint. So every transaction we are going to read, all the transactions, we need to read it from the business's view, the business's standpoint. Let's say I'm a boy, started business, so we need to put ourselves in the business. Okay, we are part of the business, so whatever we are recording for the business. I'm a purchase asset. We are recording. We are part of the business, and we are recording for the business. Do we understand? So we need to read every transaction from the business standpoint. Okay, that's another one. Then the next one is there are four elements. Four elements of account. So every transaction that you read, we have four elements of account. Either one or two of them will appear in the transaction. So the two parties to the items, it can either be one or two of the four elements. What are the four elements? We have assets, we have liabilities, we have expenses, and then we have revenue. These are the four elements of the account: asset, liability, expense, and revenue. So I'm a start a business worth 10,000 Ghana cedis. I'm a starting a business is equity or capital. Capital is a liability. So that's one. Okay, 5,000 Ghana cedi cash. That is also cash, an asset. So you see, the two parties that we are talking about, it can be any of the four elements here. So we should know that every transaction has two parties, and the two parties can be either of the four elements of accounts. That one too, we should keep it in mind that all the two transactions, the parties to the transactions can be any of the four elements of account. Okay, then then the last one the last one is saying that the parties belong to any of the four, which I have spoken about. The parties belong to any of the four elements. That one I've spoken about it. So today we'll be focusing our attention on assets and liability. For now, we'll be focusing our attention on assets and liability. I don't know what an asset is, but for the sake of those who are now joining, let me explain what an asset is. Okay, so assets are economic resources of the business. The economic resources of the business. So every economic resources of the business is an asset. Do we get it? Okay, so that economic resources of the business must be owned by the business. If high economic resources of the business is owned by the business, then it's an asset. Okay, we are not done. And then it is able to generate future economic benefit. So let's say if we sell the asset or if we sell that thing, we are able to generate benefit from it. If the benefits come directly to us, we own it and then we sell it and then we get benefits, then it's an asset. So the economic resources which are owned by the business and then generate economic benefits in future, that is asset. And then liabilities are owings of the company, so loans, overdraft, rent owings, everything, they are all liabilities. Do we get it? So assets are the things the business own and then can generate benefits, and the liabilities are the owings of the company. The owings of the company. One is owned, one is owings. We owe someone. If we owe someone, then it is a liability to us. But if we own something, if the thing belongs to us, then it is an asset. Do we understand? Yes. Okay. So today we are focusing on the assets and liabilities. We are focusing on assets and liabilities. Then we know the definition of assets and liability. Now, before we analyze business transaction with respect to assets and liabilities, we need to know some 4 basic steps or some basic steps that we have to follow. One, we need to identify the items of the transaction. We need to identify the items, or let me say the parties of the transactions. The parties of the transaction. We need to identify the items in it. So if it is bought a motor van worth 5,000, we know that the items in there will be the motor van and then the cash or bank. Started business with 5,000 Ghana cedi. We know it is the items in there are capital and then cash or bank. Do we understand? So we need to identify the items of the transaction. Once we know the items of the transaction, we will be able to analyze it. And then 2, we need to identify the elements. We need to identify the elements. So we have to know that, okay, so motor van, we know that motor van is inside. Is motor van an asset? Is motor van a liability? Is motor van an expense or motor van a revenue? We need to identify the elements of the transactions. So once we know the items, we know that it is motor van and then cash. Motor van is what? Asset. Cash is cash. Cash is asset. Motor van is asset. If we are able to understand the two, then it means we'll be able to analyze it. Then the next one is, the last one is, we need to ascertain the effect. We need to know the effect that it is going to have on the business or on the transaction. We need to know the effect. So if we bought assets, if it is increasing, what is the effect? So the effect will be either increasing or decreasing. The effect is either asset is decreasing or, do you understand? So what is the effect? What is the effect of the transaction on the elements of the account? What is the effect of the transaction on the elements? So is the effect, is the asset increasing? Is the liability increasing? Is the liability decreasing? Is the asset decreasing? Do we understand this one? So once we are able to identify these 3, we follow these 3 steps. We follow these 3 steps. We'll be able to analyze every business transaction. Every business transaction. No matter how the transaction is. Once we follow these steps, these 3 steps, we need to identify the items in the transaction. We need to classify them under either assets, liability, expenses or revenue. This one goes for expenses and revenue too. The same steps. Once we are able to go through them, we are done analyzing business transaction, every business transaction. Do we understand? Okay, so I have like some 3 examples. I have 3 examples, but then after the examples, there will be questions. I will add the questions at the end of the video so that you try your hands on whatever the difficulty, you comment it and then I'll get back to you. I'll answer every question in the comment section. Do you understand? If they need for me to do a video for that one, I'll do a video. I'm here because of you guys. So first, example, I have 3 examples that we are going to go through. So we have bought van by check. Bought motor van by check. Okay, so we are going to follow the steps. Step 1, we need to identify the elements of the transaction. What are the elements of the transaction? The elements of the transaction here are motor van and check. And then check is the same as bank. Check is the same as bank. So we know our elements. We've identified the items of the items of the transaction, which are motor van and then check or bank. Do we get it? Okay, so we need to identify the elements. What are the elements? So the elements, so you know that this item, motor van, is motor van an asset? Is motor van a liability? Is motor van an expense? Is motor van a revenue? Motor van is an asset. Motor van is an asset. So here we know that we have an asset here. And then bank or check is also an asset. So this particular transaction is having two assets. Do we understand? This transaction is having two assets. Okay, so now we need to know the effect. We need to understand the effect. Okay, so bought motor van. We are buying motor van. Meaning our motor van is increasing. Our motor van is increasing. Our motor van is increasing. And then by check. So meaning we are going to withdraw money from our bank. Meaning the total amount of money in our bank will reduce. Let's say you have 10,000 Ghana cedis and then you bought this one for 5,000. Automatically the amount, or let's say we bought it for 3,000, let me say 3,000. Automatically the amount will reduce to 7,000 Ghana cedis, which means we are losing, or our asset has reduced. Which means our asset has reduced. So that's what we are talking about here. So our asset here is reducing whilst our asset is also increasing. We are increasing motor van, but we are reducing the amount we have in our bank statements. That is all. That is all. So now we've analyzed the first transaction. Very simple, right? Very, very simple. This is how you are going to analyze every business transaction. Every business, you just have to identify the elements, know which class of which class of elements they are: assets, liability, revenue, expenses. Then you ascertain the effect. That is all. Very simple. Very, very simple. Okay, so let's go to the next one. It says a loan in cash from Gerald. So this one is the one. So, a loan in cash from Gerald, which means Gerald has given the company loan. We are reading from the business standpoint. Gerald has given the company loan. So the two items in the transaction, we have loan and then we have cash. The loan is from Gerald, so we can link these two because we'll be owing Gerald loan. So loan and then cash. Okay. Then we ask ourselves, loan and cash, these are the items of the transaction, loan and cash. Is loan an asset or is loan a liability? Is loan a asset or loan a liability? We've taken loan, meaning we are owing Gerald. So meaning it is a liability. So the loan becomes a liability, whilst the cash becomes an asset. Cash is an asset. Cash is an asset. Okay. So now we know the elements, we know the items, we know the elements. Now we need to know the effect. Now we need to know the effect. Okay, so Gerald has given us loan, meaning we are owing Gerald. Our liability has gone up. Our liability has gone up. Let's say this is Gerald's account. This is Gerald's account. And then already we were owing Gerald, let's say 5,000 Ghana cedis. Already we were owing Gerald 5,000 Ghana cedis. And now Gerald has added, let's say, 2,000 Ghana cedis to it. He has added 2,000 Ghana cedis. Sorry, supposed to be here. And then Gerald has added 2,000 Ghana cedis to it. Meaning we are going to owe Gerald plus 2,000, making 7,000 Ghana cedis. So our liability automatically has gone up because we are owing Gerald. We've added additional 2,000. We've increased our liability. Okay, now what happens to our cash? Now they've given us the cash. Our assets will go up. Our cash will increase. So this is our cash. Let's say we have cash here. Maybe the balance we were from last month is, let's say, thousand. And then Gerald has given us 2,000. So we just added 2,000, making 3,000. So meaning our cash has also gone up. Do we understand? Very simple. So our liability going up, our asset too has gone up. Simple, right? You just need to understand this and then you will be good. You will be fine. You will be fine, very fine. This is not anything different. Okay, so the last one will be 3. It says owner paid creditor from private. Owner paid creditor from private pocket. So it is saying that the owner of the business, the proprietor himself or herself, paid creditor. We are owing someone, and the proprietor has gone to pay the person from his own pocket. From his own pocket. So I am the owner. And then I've gone to pay someone at the company is owing. I've gone to pay the person an amount. The company is owing. The company that I own is owing someone, and then I've gone to pay that money. Now we need to know the items here. So we have creditor. These are the items. We have creditor, and then we have owner. We have creditor and then owner. Or let me say capital, because the owner is the owner. Whatever money the owner brings to the company is an investment. It's a capital to the company. Do we understand? Whatever money the owner brings is a capital. Okay, so now we know that the two items here are capital and then creditor. Capital. So now is capital an asset? Is capital a liability? Or is capital a revenue? Expense? We need to ask ourselves, capital. The answer is capital is a liability. The company owes the owner. So it's a liability to the company. So capital is a liability. Okay, then creditor, someone you are owing. We are already owing the person. So creditor is a liability. So we have two liabilities here. Two liabilities here. Do we get it? We are owing the proprietor and then we are owing the creditor. Okay, so now which one is increasing and which one is decreasing? Now we're going to pay the proprietor an amount. So meaning if we were owing the proprietor, let's say 5,000 and then we pay 2,000, then it means now we are owing the person 3,000. It has reduced. So this one is a decrease. The creditor's one has decreased. Now the proprietor has also added more to any amount he started the business with. He has added more. So meaning this one also has increased. Please, do we get it? Do we understand? Do we understand? The owner has added more by paying someone off. So meaning it's reduced our total number of creditors by paying some off. So our creditors has reduced, our liability has reduced, once our liability has increased. Okay, now to the problem of the day. Let me read it out. So it's the owner sold his Benz and deposited 50% of the money in the business bank account. The owner sold his Benz and deposited 50% of the business bank account. So we are supposed to identify the elements, identify the items, the elements, and then the effect on the business. That is the problem of the day. Try your hands on it. Give me your answer in the comment section. And also, don't forget you have questions at the end of this particular section. Make sure you try your hands on those questions too. And give comments with whatever problem you encountered. But hey, don't forget to solve the problem of the day. Don't forget to solve the problem of the day. The proprietor has sold his car, and then he has tried to deposit 50% of that amount in the business. Identify the items in it, the elements, and then the effect. Thank you for staying with us. Thank you for always being with us. Make sure you try and answer our questions. KS tutorials, keep calm. KS tutorials, balance on.